Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios, Friday morning. Once again, will it be like any other Friday we've had for many weeks, or could it be a little different? Lots of news flow as always to tackle. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, hi, good morning.
Hi, good morning. And we're coming out of a painful Wall Street session. It reminded me of that word pitai. It almost felt like the, Nasdaq ki pitai ho gayi with it, 2.5% fall. But even for the Indian markets, right? The mid-cap index, the small-cap index, the way it came under pressure yesterday was a bit disappointing.
Well, the mood is very, very somber, particularly in the broader markets. You speak to anyone on the street, the mood is somber with regard to the broader markets. And as you have said, it appears now the Western markets have suddenly made a near-term peak. So that's going to be a bit of an issue. But guys, cheer up. Today's salary day. It's the end of February as well.
It's a Friday.
Yeah, and hopefully India already had a bit of a cold while the world was very, very healthy. So hopefully, from here on, there could be some bit of an outperformance. That's the hope. Let's see how it goes.
No, absolutely. And but the point about the US is important.
Yeah.
And that was making the point yesterday and day before that maybe the top for US tech is in. And let's see if that is the case. And I'm just saying US tech because nothing else matters really. Is as good as saying is a top in for US markets. We don't know. Maybe just a small pullback or something more meaningful. But we are seeing signs that maybe there is a little bit of sort of fear which is starting to set in for the first time after a few years. So let's just quickly take a look at price action. So equities, sharp correction. The S&P down about 1.6, NASDAQ down about 2.7%. So these are sharp sell-offs that we are looking at. NVIDIA, by the way, and yesterday, again, same point. Stock ended undecided, but we were saying, well, it's never the first day with a name like NVIDIA and all the baggage and the history and the price action we've seen. Sometimes the market just waits a day more, conference call, everything in the in, and then the stock reaction comes through. 9% last night, down. And that's the number one name in the US, right? The CBOE Wix was up about nearly 11%. We are back above 21 levels. And there was another googly which came. So this is Donald Trump, US president, putting an additional 10% tariff on China on top of the existing tariffs that, of course, already are running. And this will come into effect in March, from next week, basically. The 25% tariffs on Canada and Mexico will go into effect, he confirmed, from the 4th of March. That was something which was being talked about. I mean, there was some confusion whether it will be delayed to April, whether it is till March. So he confirmed, well, the Canada and Mexico tariffs are from next week, which is the 4th of March. But the new thing was this 10% tariff on China as well. Now, the thing is whether this will be sort of, monthly increases in tariffs, as some have suggested. Who knows? But for now, we know that starting next week, unless, of course, we hear something from China, and I think we should hear something from China today and over the weekend, because this is just next week. Maybe there is a negotiation of some sort, but this was very clear from President Trump last night. Now, and that essentially what took the market a little off guard in that sense. Dollar index went up as a consequence because of the tariff headline, about 0.9% higher, back above the 107 level. The 10-year yield, small drift up, but the point is it had sold off 15 basis points in the prior two sessions, so not very much at all, 4.27. Data also beat consensus. So durable goods data was better, but you also had the initial jobless claims number, which beat consensus, which isn't exactly, all that great a thing. Oil prices about 2% higher, $74 a barrel is where oil finally is now, settled last night. The other bit, of course, is with regards to whether there will be a ceasefire between Russia and Ukraine. And Trump confirmed that he will be meeting Zelensky, the Ukrainian president, in the White House today. And that minerals deal where U.S. gets access and the rights to develop Ukrainian rare earth, oil and gas assets in return for some protection or kind of mediation with Russia, which essentially leads to some sort of durable ceasefire. So watch out for headlines there. And of course, here back home, we've got late last night, there was the announcement that we've got a new SEBI chairman. He's a name who is very, very, very familiar in Delhi circles, in Mumbai as well. He was, of course, the finance secretary. He's the finance secretary, but he's also in charge for disinvestments, and that's the man. Mr. Tuhin Kanta Pandey will be, of course, here in BKC, the SEBI headquarters, and he will be chairman at SEBI. The tenure is 3 years. He turns 60 in August, but he's been given a tenure of 3 years. So a fresh start at SEBI. And of course, we'll get you more on this one as we go along. So you got a fresh start at the RBI. You got a new person at the RBI. You got a new person at SEBI as well. We'll discuss this in greater detail. Just to tie in the levels here. So the Nifty, first up, support stands at 22,396, 22,400 essentially, about 150 points away from where we left off. Resistance zone, 22,668 to 22,720. Nothing very different. I mean, similar kind of levels I put out yesterday as well, because yesterday the market was flat. And the Bank Nifty needs to close above 48,970 initially. That's the first very, very near-term resistance that we're looking at. And support here stands at 48,130 and 47,844, which is the prior low, the previous low. The GIFT Nifty will come up on your screen, gives you a sense of how we're likely to start. It's down 100 points in reaction to the Wall Street sell-off. I mean, that's the Nifty. But the point is, broader markets have been where the real pain has been, because even as the Nifty was flat yesterday, those indices were down between 1.5% to 1.75%. So I think that's something we should continue to focus on a bit more beyond, of course, just the headline Nifty and Bank Nifty indices. Guys.
Well, so let's just stack up the performance so far this week. In a truncated week, the mid-cap index is down 2.7%, while the frontline indices are down over 1%. But perhaps yesterday, the Nifty staying flat was to do with expiry, and we'll wait and see one day after what happens to the benchmark indices. But look at the way the S&P 500 and NASDAQ, 5% lower from Monday to Thursday for those key US indices. In terms of flows, the DIIs bought 1,700 crore in the cash market, while the FI selling was restricted to 556 crore rupees. Lots of important news flow. Top of mind is, of course, the new SEBI chief that Prashant was talking about, Tuhin Kanta Pandey. SEBI has also mandated the deployments of funds raised via NFOs within 30 days. This will be effective 1st of April. If you don't do that, then there is a penalty or you need to explain. This is to avoid mis-selling. So if you raise money via an NFO, it has to be deployed within 30 days. So watch out for AMCs. There is an MSCI rebalance which comes into effect post-market hours close today. According to IFL, we could see passive inflows of $1.4 billion. The key changes, Hyundai is included in the standard index, Adani Green is excluded, and there is some weight changes in IndusInd Bank, Zomato, Varun Beverages, Mankind Pharma. That list is up for you on your screen. And the Feb auto sales will be out over the weekend, so they should be on your watch list, particularly after Siam lowered the estimates for passenger vehicles in the coming year.
Well, that's right, Rima. A couple of points from what you said. You know, the MSCI rebalance, that will keep the flows looking a little bit skewed in today's trading session. Yesterday was not too bad as well with the FISL number of 500 crores. And the other factor is the Nifty Bank is showing signs that it wants to fight back. Last couple of trading sessions, it's made a higher high as well as the higher low. But February, as we mentioned, well, it hasn't been a good series. And there are 4 big points really that stood out. And that was the reason that we were underperforming. And it appears 2 out of the 4 at least have corrected themselves, because the valuation concerns, well, we are a little better placed in terms of valuations. And the Q3 results were not very, very great. But hopefully Q4 could show some kind of an improvement. That's the hope out there. While the other 2 are not in our hands, that's the FI selling as well as Trump's tariffs. So we'll have to keep an eye out on both those 2 factors. But at least 2 out of the 4 have corrected themselves. Well, moving to the other couple of data points. Everyone's talking about this, right? The record after around 28 years, we have 5 straight months where the Nifty ends in the red. Not a great data point, right? But, you know, that time in 1996, we corrected by close to 26%. This time around, we have corrected by close to 13%. But everyone's been talking about this data point. I don't want to go back so much in time. But since everyone's talking about this losing streak, what happened next? The next 1 month post that in 1996, post that losing streak, we're a little bit higher. 1 year later, we were higher. And 3 years later, we were much higher. Not going to say that it will play out exactly the same this time around, but that is the case, right? If you look at the data point of 1996, then just check out what happened post that as well. The short point is, in the longer term, well, markets do rebound, you know, in the longer term. So just keep an eye out on that factor. Don't get too underwhelmed with regard to that factor. What else are we looking at? How is the Nifty open interest at the start of series? Not too much change, as heavy as what we were at the start of the last series as well. But what about positioning? The FIs, they're as net short as what they were at the start of the last series itself. In percentage terms, they're a little bit lower, at around 85% or thereabouts. What about clients? Well, clients, actually, their long positions are a little bit lower on the index futures if you compare it with what we saw at the start of the last series. So on the long side on index futures, that's a little bit lower. And if you look at the client positioning, even on stock futures, well, they continue to remain net long, but those long positions are a little bit lower out there. While the FIs, they are long positioning on stock futures a little bit higher. Keep in mind, there could be hedging as well that at play out here. But net, both clients as well as FIs on stock futures, they are net long. Moving to the options data, 2 strikes come up for you on the screen, fairly active in yesterday's trading session, which gives you a near-term range. On the downside, that 22,450 level, well, you don't want that to break on the downside. While on the upside, the 22,750, that's the important mark that you're looking at. Stocks that I'll be looking at, well, Premier Energies, that one, there's a 6-month lock-in post-listing. That comes off today, so some stocks will be available for trading. This has been a bit of an overhang on the stock. We'll have to see how much of it does materialize, because otherwise the longer theme looks good. So today is a test for this particular stock. A lot of people waiting by to see what happens from here on. It's more than double from the IPO price, but it's come off drastically from the top. Net, the March series starts off today, and dare I say, since we have already underperformed, maybe in March, the Indian markets could outperform. Just talking about the headline Nifty itself.
Well, that is the hope. But let's move on and get the equity calls then. We have opinion coming in from Chris Wood of Jefferies, who says, in India, for the first time since the stock market started to correct properly, greed and fear's base case is that the sell-off is primarily technical in nature, reflecting multiple compression rather than any drastic macro issues. The sell-off has also been more painful than suggested by the Nifty benchmark index because of the much bigger decline seen in the small and mid-cap stocks where the multiples were much higher. A major driver of the sell-off has been aggressive foreign selling, where foreigners have sold net $12.2 billion worth of Indian stocks so far this year, after selling a net of $12.3 billion in Q4 FY24.
Richard Harris is now with us here. He's Executive Director at Port Shelter Investment Management. Richard, good to have you with us here. Thank you very much for your time. Simple question. Do you think a top is in for a US Magnificent Seven?
Well, it's certainly looking like it at the moment in terms of an intermediate top. I think, the Magnificent Seven, they're still great stocks. They're still the place you probably should have a big chunk of your investment, because they're not going to go away. They are the darlings of our era. So you really do want to have an exposure to them. But I think that the general mood of the markets is softening quite a bit. We're seeing some not quite so good data coming out of the US. We're seeing President Trump being extremely irrational in many areas. And I like the way you talk about him bowling a googly earlier. In fact, maybe he's bowling more of a flipper, because he comes up with these big ideas, tariffs here, tariffs there, and then he rows back on them. So it's very difficult, I think, for the markets to try and get a grip on where policy is actually going. And that, of course, is going to lead much more to risk off than risk on.
So that's about the US tech. What about the US equities in general? Is there reason to be bearish about US equities? Because the main driver for US markets last year were AI dominance, one, and secondly, the strength of the US economy. And now there are flashing warning signs on the US economy too in terms of the latest economic data. So on the whole, what is the call on US equities?
Well, I think the call is probably that we're going to see some weakness. So I think I'm not looking at any form of big crash, but I am looking at the market languishing for quite a while. And I have been saying for 3 or 4 months now that we're in an era of the great pivot. We've seen the US be very strong now for 3, 4, 5 years, easily outperforming the rest of the world, and very much outperforming China, which is still suffering from, its post-COVID malaise. But in the last year, the Chinese authorities have made great strides in trying to reflate their economy. It looks from some of the indicators that they're doing quite well on that. As we all know from reflation, that a lot of that money ends up in the stock market and the investment market. So far, it's been China tech, but I think that we're likely to see more and more money go into the markets, which means that the Chinese market is likely to outperform the US. So that's where I see the pivot occurring.
Richard, what about the Indian markets? We have suddenly taken a backseat. We've gone into a lull for the last, 6 months or so. In cricketing parlance, we are sitting in the pavilion, waiting for our chance to come out and bat. And it appears the FIs have deserted us for now, at least. Do you think post this correction that we have seen, valuations as well, a little bit better than what it was a few months ago? Where does India stand right now?
Well, I think the advantage is you're sitting in the pavilion. You've still got a few batsmen to come. The Indian economy, I think, is in a pretty good position. And if you look back, and I'm much keener in many ways, if you're looking to forecast, just look back over not just 6 months or a year, but look back over 2, 3, 4, and you can just see the incredible performance that the Indian market has had. So it's not a particular surprise, I think, that it should start relaxing a little bit, languishing, people taking profits, people saying, okay, where's the next step coming from? There are concerns out there about what Trump is doing and the impact that might have on global trade. And there is obviously, I think, some competition from China now as a big EM market, although you can hardly call China EM. These days, you can almost not call India EM. But there is concern that those markets are mildly competing. So investors looking towards China might actually be distracted away from India for a little bit. But personally, I'm not terribly concerned. I think the Indian economic story is still intact. But of course, markets don't go up in a straight line.
So China outperforms the US market. But what about India? Can we, move in step? Or do you think we continue our period of underperformance for a little longer?
Well, I'm much more of the camp that I think India is likely to move in step. I don't think there's much likelihood of underperformance unless there are specific India-based issues that we don't know about at the moment, the unknown unknowns. But I think if you're looking at the known knowns, India is likely to continue to be quite strong. The only proviso, of course, is that if global growth slows down a lot, largely, I think, because of Trump's actions, because markets aren't that robust, so the kind of things he's talking about are likely to create uncertainty, then, of course, India is going to suffer. But that will be the same with equity markets all over the world.
All right, Richard, we'll leave it there. Thank you very much for joining us and running us through a lot of that perspective, which is much needed. Appreciate it.
Out there, if the imports on China goes up, will the attractiveness of Chinese equities come down? Because that's an additional headwind. And plus, MSCI China is up more than 15% so far this year. So,
but these are pointers. Absolutely, 100% right. And but this is a very short term. I mean, I think the Hang Seng Tech Index, for example, or the MSCI China Index is up. But this is very. These markets have underperformed for a long
time.
Very long.
Very
long time.
I think the index itself, the Hang Seng Tech Index, had halved, and then it has bounced back from there.
So, I mean, on the longer run, I mean, the underperformance is huge. In the shorter run, there may be some tactical unwinds, etc. But we'll see. And of course, who knows, right? I mean, between now and Monday or the 4th of March, when these tariffs are supposed to come, as Richard was saying, maybe we see another googly, who knows? So we'll just have to play it by the year on a day-on-day basis. Well, we've got lots of stock-specific action coming up in a bit from now with the research team in terms of the top 10 segment. We're looking at Coal India, Crompton, Interglobe Aviation, Tata Power, Translate Lighting, Schaeffler India, RVNL and GE Power on the back of positive news flow. And on the other side, we've got Granules India, Premier Energies, and a couple more which are on the radar in terms of negative news flow. So that's what's coming up here in a bit.
Welcome back. You're watching Friday's edition of Bazaar Morning Call. Yesterday, markets closed absolutely flat in the benchmark indices. But this morning, given the slide that we had on Wall Street overnight, the GIFT Nifty is suggesting a deep cut of 150 points as we begin trade with. And mid-caps and small caps back home have anyway been underperforming. But let's drill it down to individual stocks. Research team is standing by with our top stock list of the day. Nigel, first up, Coal India, some price hike.
Well, Coal India, in closing bell, we had mentioned there's a possibility that the street is sniffing that there could be a price hike that's on the cards, and that's why if you saw at around 12 to around 1, the street has been sniffing this for the last few sessions. You did see a big spike up out there. In post-market hours, we have this news that's come about. The 300 rupees per ton of levy has been, uniformly implied across the NCL, subsidiary of them. So because of that, this will take effect from May 1st, and the total quantum of revenue, additional revenue, will be around 3,880 crores approximately. Just NCL as a percentage of the total dispatch mix is closer around 18% on an average. Even year to date, it's been around that mark. Now, most of the brokerages, they're quite positive on this because some of this money will be used for rehabilitation of the village area, and the mining areas out there. But that was already in price. So Capex was already in the price. Now, this will be additional revenue that will flow through. And most of them believe that the revenues that they will be getting, most of it will flow through the profitability. So Nuvama, they have quantified that. They are saying that it will up their EBITDA estimates by close to around 9 to around 10%. They're giving it a multiple of around 5 times EV per EBITDA. And that's why they're getting a share value of close to around 34 rupees per share. They have a current fair value of around 419 rupees. So it's a positive. The additional charge will result in additional revenue, which most of it will flow down to the EBITDA factor. So that's why I expect the stock to open up well in the green. But Crompton had an analyst meet. Upasana joins us to help us out with the key takeaways. Morning, Upasana.
Good morning. So Crompton in its analyst meet has indicated that company is well on track on its Crompton 2.0 strategy, which mainly focuses on industry-wide PAT growth, arresting the decline in the lighting market, and also turnaround of Butterfly. Now, company has indicated that the summer season has boded well and has started on a good note for the company, and the company is getting a good push from the newly launched products. Now, in the fan category, company has launched 2 cutting-edge platforms, that is Nucleus and X-Tech, aimed at driving energy efficiency and smart technology integration. Now, company has indicated that it aims to solidify its position as a leader by increasing the share of premium fans from current 25% to 40% in the next 3 to 4 years. Company is also focusing on solar pump market, generating a cumulative revenue of nearly about 200 crores is what they have indicated. And lastly, company has said on Butterfly Gandhimati that the rejig has been completed and company aims to achieve mid-teen kind of growth in this category. So overall, positive comments from the management. Hence, I expect the stock to open in green today.
All right. Thank you very much for that. Well, Vinny is now standing by. Interglobe Aviation and Granules India are stocks we want to focus on. Vinny, good morning.
Good morning. So yes, Interglobe Aviation, that's in focus. We do have the air traffic data that came in last evening. Interglobe Aviation continues to sustain in terms of the market share. And now the market share has grown versus December 2024. 64.4% was in December 2024. Now it's come up to 65.2%. So some bit of an increase in the month of Jan in terms of air traffic data and market share for Interglobe Aviation. Other than that, who's lost share also is something SpiceJet as well as in terms of Air India, they seem to have lost some bit of a share in the overall performance in January 2024. On-time performance, most of the flights fared below that 80% mark. Interglobe Aviation was still the best among that, 75.5% in the month of January. Keep an eye out on Interglobe Aviation. Market share continues to be about the 60% mark, the leader in the Indian airline space, so keeping out for that one. Other than that, Granules India, we have some bit of a negative news that has come in. We know that the Gagillapur facility that was inspected in August, and then they got an OAI, that's official action indicated in December, with observations that came in the Form 483 as well, which were severe observations. Now, furthermore, yesterday an update came in that they have received a warning letter. There's no escalation furthermore, but a warning letter that has come in. Warning letter means and indicates that, the imports that are there for new products, that will not happen. Any clearance for new products will not happen from this facility. The old products will continue still be manufactured and marketed in this facility. So keep an eye out on Granules. We're expecting red here. This is an important facility and that continues to be under the US FDA's radar right now. So that is one we're watching out for.
Thank you very much for that. And now it's over to Vivek for Transrail Lighting and Tata Power.
Well, that's right. Both stocks in the news on the back of order wins that have come in. Transrail Lighting, the company yesterday announced that it had received orders of a little over 2,750 crore, and this particular orders mainly have come in from the T&D, the transmission and distribution segment. YTD order inflows for the companies have now crossed 7,400 crores. indicating that over FY24, they've actually seen an order inflow growth of close to 90%. Remember, at the end of Q3, the order book stood at close to 11,500 crores. So some positive news flow as far as Transtrail is concerned, boosting the order book. Now, coming to Tata Power, very interesting development. The company's subsidiary TP Solar has received a 632 crore order. This is a contract from SECI, which is the Solar Energy Corporation of India. Now, the company is going to go ahead and supply 292.5 megawatt peak DCR solar modules. This particular contract is for a project and for a specific site in Andhra Pradesh. Some positive news. So interesting that Tata Power has actually participated in a SECI tender, and almost 630 crore order, boosting their order book as far as that particular EP solar business is concerned.
Okay, all right. Thanks a lot for that, Vivek. Well, let's wind this down with Sudarshan, who's here to tell us about some more stocks and news. Morning, Sudarshan.
Morning, Nigel. So I'll start with Schaeffler India. It has reported Q4 earnings growth. It has reported double-digit revenue growth for third straight quarter, and led by automotive tech business. Revenue was up 12%, even margin was steady around 18%. Next is RVNL. Company has bagged rupees 136 crore order from Central Railway, and it is for the Bhusawal and Khandwa section. And this order is going to be executed in next 2 years. GE Power, it has bagged second order in the week, and new order is of rupees 274 crore bagged from Greenco, and this is going to be executed by November of 2027. Last one is Premium Energies, because shareholder lock-in period ends today, and 10.6 crore shares, or say 23% of total outstanding shares, will be eligible to trade today. Remember, the stock was listed in September 2024, and it was one of the strongest listings of 2024, and stock had gone on to hit record high of nearly 1,400 per share, and from that level, it's now down nearly 33%. So keep an eye on these stocks.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Coal India, Crompton, Interglobe Aviation, Tata Power, Transrail, Schaeffler India, RVNL, GE Power. Stocks with negative news flow are Granules India and Premier Energies. Moving on to the other important news, the MSCI India Index rejig comes into effect today, post-market close. Vivek is here to tell us more. Vivek.
Well, that's right. So the MSCI India changes will come into effect from the next trading session, and the changes will actually happen, or the flows will happen in the last hour of the session today. Remember, this particular development was announced on 12th of Feb, and this is a net inflow event as far as Indian equities are concerned. IIFL Capital, the alternative desk, expects close to $1.4 billion of inflows today on the back of this particular MSCI rejig. So it will be important to see the FII data later on today, whether it comes in as a positive number on the back of the MSCI rejig. What are the key stocks to watch out for? The MSCI Global Standard Index. Hyundai India makes inclusion as a recent listing. On the other hand, Adani Green Energy will be exiting the particular index. Along with that, on the back of IndusInd Bank having increased FPI headroom, that particular stock sees a weight increase and a weight up, where flows of close to $258 million are anticipated. Along with that, 19 additions and 19 deletions from the MSCI India Small Cap Index will also happen in the session today. India's weight in the MSCI EM Index after the November review actually drops down to 19%. At the end of the November review, it was 19.8%. This is due to India's underperformance from November to February.
All right. Thank you very much for that, Vivek. Manisha is now joining in for a quick roundup of all the action from the commodity space. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'll start with the crude oil prices, which is headed for a first monthly decline in 3 months. We've seen prices gain up by 2% overnight, but that is where this ends, because when you look at a month-on-month YTD, Y-on-Y in sense of crude oil prices, we are slightly in the negative there. But the global economic growth slowdown concerns are there, and the U.S. tariffs on Mexico and Canada to take effect from 4th of March is something that's bothering not just the crude oil prices, but the metals as well. So most of the ferrous metals, non-ferrous metals, even the precious metals have gone for profit-taking. Gold is trading at a 2-week low. Silver prices fell 2% overnight. Sugar prices fell 3% globally overnight. We've seen rubber prices come off their 1-month highs as well. So many of these commodities, also taking impact from strength in US dollar index, have started Asia on a weaker note.
Okay, all right. Thanks a lot for that, Manisha. For the time being, though, we slip into a short break. Up next, we'll join by Siddharth Khemka of Motilal Oswal Financial Services for some fundamental stock analysis. Stay with us.
Welcome back. Now, the Appointments Committee of the Cabinet has appointed Finance Secretary Tuhin Kantapande as the new chairman of the market regulator, SEBI, for a period of 3 years. The tenure of the current chairperson, Madhabi Puri Butch, ends today, and the new chairperson will take over from Monday. That's the 3rd of March. Mr. Pandey has served as the Revenue Secretary since January this year and previously as the Divestment Secretary as well. Well, Mr. Pandey, responding to a CNBC-TV18 question recently in the post-budget conference here in Mumbai, spoke about the Indian market and the FII selling that we've seen so far. Listen in.
FIIs keep moving up and down depending upon where they want to really park themselves, and it is not true that the FPIs are really moving from one emerging market to another. I think the general thing is that there is a little bit of, whenever there is a global uncertainty, they would really go back where they actually come from. In terms of resilience, Indian markets have held, although there would be, any demand and supply impact would be felt. But these are the issues of temporary measures. If you really look at Indian economy, because eventually, the returns are obtained in the real sector, because the financial sector cannot really just be in a bubble. In the real terms, Indian economy is in a very good resilience, remains one of the fastest, in fact, the fastest large economy.
All right, that is the new SEBI chairman, coming in now. Mr. A. Balasubramanian is Managing Director and Chief Executive Officer at Aditya Birla Sun Life AMC. Bala, good morning. Good to have you with us here. Good speaking. It's been a while. So, new regulator coming in. Bala, first thoughts, first reaction. Someone who's very well known in Delhi, and of course, someone who's very well known here in Mumbai as well. I mean, he was, after all, he's held very senior positions. He's been part of the budget making process. And of course, from a market standpoint, was the divestment secretary as well.
Correct. Good morning, Prashant. Thanks for having me on the show. Definitely, I think it's a good choice from, I think, as you mentioned, and he has been, of course, involved in various policy initiatives from the Ministry of Finance, working closely with capital market players, including the regulator. And he has done great work as part of DIPAM secretary in bringing in practices which helped actually most of the public sector companies to raise capital right from banking sectors, and also took out the largest IPO of life insurance corporation, and also has been deeply involved in helping the public sector companies to raise capital at the right point of time, especially in the last few years. If all of us try to recall, public sector companies not only have been well capitalized, their balance sheets have improved quite significantly, and they've also been party to the overall growth momentum that I've witnessed in the country, which has largely come on the back of, one, public spending from the government, from the budgetary allocations, as well as public sector companies making huge investments in bringing their capital investment to the next level of growth to drive the growth momentum. And I assume Mr. Pandey has played a very big role in this, being part of the Ministry of Finance. And his understanding of the capital market and the need of doing a business on a variety of things, I think being closely working with the government on multiple areas, I can only help in the Indian capital market to go to the next level of growth. So having done, I think we must also thank Ms. Madhabi Puri, who has been part of the institution for the last 6 years, brought up a lot of revolutions and a lot of safety mechanism. This is also most important in the rising equity market in the fast-growing economy. It is equally important to have the right regulation in place, and safety mechanism also should be in place so that we don't have any kind of accident in the market. At the same time, help companies to raise the capital from the public market.
No, absolutely. I have to say, and you would agree with me, right? If you go back, I've looked at different SEBI tenures, maybe going back 20, 22 years. You've, of course, much longer. The last term under, Madhabi Puri Butch was one of the most active, right, in terms of new regulations and lots of changes coming through in pretty much all segments. we highlight what's happened on the F&O side, but it's not just F&O. I mean, lots of other changes have been introduced. As a market participant, more than anything else, Bala, what do you think the new sort of incoming chairman needs to focus on rather? One or two things, very specific. Maybe a change from the past or something new. Go on.
I think, in all certainty, Madam Adil Buj was extremely active and going into deep in terms of every decision-making processes. Also, I've been getting the best out of one of the best talent SEBI also has got at the lower level officers. They're all extremely sound and solid when it comes to the question of their own knowledge. So they've also been helping the earlier chairman to come up with various policies. I think in order to, as we move forward, clearly the areas where ease of doing business, especially on KFC, given the fact that Mr. Pandey is coming from the government, there is a high probability the single KFC model could become one of the ask the developers have been having it for quite some time, linking to the bank account. Maybe that could be one. And second is, whatever the tightening measures that has been taken, whether it is for the mutual fund, whether it is for the capital market, in the stock market, there are some of the tightening measures which were taken, which of course needed the hour at that point of time. There will also be merit for them to be revisited, given the fact that industry is also learning and putting systems and processes in place, and technology actually playing a larger role in monitoring such kind of things. Those are some of these tightening measures which was taken when the systems are not in place and processes are not in place, and those are not being implemented. There is a high probability the new chairman may also relook at some of the tightening measures and on a case-to-case basis and see whether those can be relaxed so that the capital market progress can happen a little more better than what we have seen. I think there are many things are in place.
Yeah. Just wanted to get your quick word on the new NFO rules. SEBI has mandated deployment of funds in NFOs within 30 days. Generally, are AMCs able to deploy funds within 30 days given the volatility that we've seen in the market? Typically, how long does it take for the deployment to take place? And how difficult will it be to now implement these new rules?
So I don't think any difficulty will be there. And given the fact that in general, most of the money managers prefer to invest this money, say about 40 to 50% of the money, they try to construct the portfolio within a matter of 1 month. I think what the mandate says is about not 100% of the investment should be made, at least about 70 to 80% of the investment should be made within that period, which in my view is not that difficult. And also given the fact the money is being raised at that point of time, keeping in mind that there is a merit for such a product exists, therefore the money is being raised. Therefore, there is also merit for the 30 days period of deployment. Also comes from the fact that when you raise money for investing in equity, that keeping in cash may go against the investor's interest if the market reverses and go against your own estimates. Therefore, they're not giving that choice to the money managers, and money is not being raised to keep it in cash. Money is being raised to actually invest in the market. Therefore, the earlier period of this thing, there was no such a regulation which was existing that within certain period, it was almost about 6 months period. Therefore, it will be brought down to 30 days. In fact, 50 to 60% of the portfolios, most of the money managers either try and replicate the index initially and deploy it, and then start investing in stocks as and when they feel necessary. That option still will be there with money managers to manage the new regulatory framework. I don't think it will be difficult for money managers to. It may look a little harsh for the money manager to go and deploy the money. The choice of money manager to deploy, he can invest in index funds, and then as and when he finds right stocks, right valuations, right price, he will have enough leeway for him to deploy it over a period of time.
All right, Bala, we'll leave it there. We'll continue this conversation, and we hope that we get a chance to speak with Mr. Tuvinkanta Pandey. And I'm sure there'll be sort of industry consultations, etc., as well when he takes over. You'll be up there right in front. Thank you very much, Bala, for joining us with that perspective. Well, we'll take a quick commercial break here. We're going to come back with some fundamental stock check. Okay, I think we have Nigel Sid Khemka with us.
Yeah, let's get to Sid. Hi, Sid. Good morning. Good to see you, Ben. Sid, let's talk about a couple of stocks that are going to be in focus. Coal India, they've gone ahead and for one of their subsidiaries, which is NCL, that constitutes close to around 17-18% of their total dispatches. They've announced a hike of around 300 rupees. Now, this money will be used for development, supporting the village as well and the surrounding area. However, most of the capex is already in the price. So that's why various brokerages, they believe that most of this 300 rupees, which amounts to around 3,800 crores, will flow through to the EBITDA level. Your sense, what's your view on Coal India? Yesterday had a bit of a spike. It's corrected a goodish deal from the top. But if we're looking at decent PE and dividend yield, well, this could fit the bill. Your take.
Good morning, Nigel. Good morning, Prashant. Glad to be on the show. So yes, I think that's a positive move there with Coal India charging that 300 rupees per ton extra in the name of the development. I think that some of the capex has been done, and some portion of this will be used for the community development. However, definitely a lot of it will flow through the EBITDA as well as to the net profit. So we also expect this to be a positive to the tune of about 5 to 8% improvement in the EPS over the next financial year. I think valuation-wise also, as you rightly said, yes, looks very attractive. Dividend yield pretty strong. Q3 saw good numbers, strong volume growth.
Siddharth, we've got you in a bit of a scratchy line, so we'll just try and fix that. For now, we'll slip into a break. On the other side, we'll continue chatting with Siddharth. We'll also get a few technical trades lined up with Shrikant Chauhan and Sudeep Shah.
Welcome back. Before we get to our technical experts, let's get back to Sid Kemka. Sid, I believe now we can hear you, so that's good. Your view on Coal India post this 300 rupees per ton increase for NCL, which is 18% of their total volumes?
Yeah, hi. So sorry for that bad audio. I think definitely that's a positive news flow for Coal India at this point in time. A bulk of the capex is done, and we believe that a lot of this would flow through EBITDA and to the net profit. So what we are expecting is about 5 to 8% improvement in profitability next year because of this additional 300 rupees per ton that they are going to charge. Valuation-wise, looks very attractive with a high dividend yield. Even Q3, we saw strong volume growth of 15% on a sequential basis. Net profit increased 35% sequentially. So overall, we believe that Coal India is likely to sustain a strong volume growth in the near term, as well as improvement in realization that should drive growth. So overall, we remain positive on Coal India. We have a buy rating and a target price of 480.
Nirmal Bang today has a strong buy on Polycab. They've upgraded the stock to a buy. Their target price stands at 6,228. And they're saying that it won't impact Polycab. It will have a bigger, this Ultratech's move to enter into cables and wires will have a bigger impact on housing-focused and B2C players like Finolex Cables and Havells. So Polycab is a strong buy. So Siddharth, yesterday after the carnage that we've seen in this entire sector, what is the advice? If someone has stocks, should they continue to hold on to it? Should they go out there and top up their investment? Or are there stocks that you would advise unwinding and unloading right now?
Definitely, I think the announcement by Ultratech to enter into the cables and wire segment is a disruptive move, especially for some of the incumbents with the large capex of almost 1,800 crores that Ultratech has announced. We have seen the disruption Ultratech could manage to do in a much more closed, or you can say a duopoly kind of environment in the paints industry. So I think definitely there is a pain, but on the positive side, I think there is still some time away for the capacity to come in and for Ultratech to enter the market to do any kind of impact on the financials. Nonetheless, I think this announcement definitely leads to a kind of a de-rating environment in the cables and wire segment, which have so far been able to command a premium valuation. Even we have cut the valuation multiples by about 20% for Polycab, KEI, RR Cable, and for Havells by about 10% given its diversified presence. We have also downgraded our rating on KEI and RR Cable to neutral from buy. We believe the stock could remain under pressure or could languish until some time where the valuation, the new normal of the valuation is achieved. But we are continuing to maintain a positive view on Polycab, where we have a buy rating. We believe that is the market leader could continue to grow at a much faster pace. We have a target price of 6,950. If you look at even the quarterly numbers have been pretty strong. We believe that the earnings growth could be pretty impressive going forward, about 13-14%. And given the market leadership, the impact of Polycab could be on a smaller players, much larger compared to Polycab, which continues to command more than 20% share in the cables and wire business.
Sid, morning, Prashant here. So I have two questions actually. Let me just start with the SEBI related one. Any reason why any of the AMCs, capital market plays, etc., should react with the new appointment at SEBI?
I think there should be policy continuity in terms of SEBI, as we heard Bala talking about how a lot of positive developments have happened in the last few years under the outgoing chairman. A lot of further developments needs to be done. I think the overall capital market continues to remain strong, and with the minor blip that we are seeing because of the market pressure, volumes going down, there are questions about the continuity in the growth of SIPs. I think if the near-term blip stocks have come down, we definitely like the capital market theme as a long-term positive structural story. Something like a CAM, CDSL, we have seen a good correction and believe it's a good buy at current levels.
You know, fair enough, CAM, CDSLs, etc. The other one is banks, right? So yesterday the top gainers were Shriram Finance, Bajaj Finance, Bajaj Finserv, Chola, Credit Access. The MFI was up 10%, was up 18% at one point intraday. And the index itself was up 0.5, 0.6%. Changes the RBI in terms of loosening things and easier rules generally seems to be, and this is a departure from earlier. And that's what the market is reacting to. Any thoughts here? Anything you like here, Sid?
Definitely, I think if you look at the past few developments from the RBI side, they have been largely moving back to an environment where they're giving more freedom, or we can say, to grow. Not only the CRR cut or the OMO operations, this reduction in risk weightage definitely leaves more liquidity for some of the banks to lend. The cost of capital for MFIs, for NBFCs will come down because of the reduction in risk weightage. What we like Shriram Finance, which is in the large cap space. We see strong growth, recovery in the CV side, tractors also doing well. So that is one of the preferred ideas that we like from the entire NBFC space. Microfinance, I think there is still some time away. The Q4 numbers would again remain subdued under pressure, so we'll maintain an underweight view on microfinance. But within the larger financials, we like Shriram Finance. Chola is looking good. LTFH, L&T Finance is also now with this improvement in liquidity, cost of capital coming down. I think that should also start doing well.
Okay. Thank you very much for joining us, Sid. Appreciate it very much, your time here. Well, I just want to take a quick look at, we're talking about capital markets, right? Just put up the chart of BSE, that's Bombay Stock Exchange. Stock was down 6% yesterday, 6.5% yesterday. This despite, I saw some upgrade yesterday from one of the brokers. Of course, broader markets were down, so there is that. But that's, when you think about, well, where are changes going to show up with regards to this new appointment at SEBI? I don't know if you can link the two, but BSE was down notably 6% at about 51.60 or so yesterday itself. We'll take a quick commercial break here. We're going to come back. Some technical trades lined up. Shrikant Chauhan and Sudeep Shah are our techies this morning. Stay with us.
Welcome back. Yesterday, the Nifty held on to 25,500 for the third day in a row in a very quiet, subdued kind of a trading session. But the mid-cap sell-off continued for the fourth day in a row. And in the last, three trading sessions, because this was a truncated week, the mid-cap index has lost 2.7%, 3% gone for the small-cap index. But what's the approach to trade today after the suggested gap-down opening? Shrikant Chauhan and Sudeep Shah are now with us on the show. Gentlemen, good morning and thanks for joining in. Shrikant, let me start with you. If you get a gap-down opening, perhaps 150 points, what's the advice?
Good morning, Rima. Good morning, everyone. After opening gap down by nearly 150 points, we could see the next levels or next support levels of 22,200 or 22,300, where the market is having next leg of support in terms of extensions and retracements. But as the market has left the level of 22,500 and it was like not rebounding from those levels, we could see the levels of 22,000 in the near term. So with a very short-term view, we should look for taking some contra bets close to 22,300 because the markets are oversold. Most of the stocks, especially index heavyweight stocks, have fallen to their extreme levels. They are down nearly 25 to 30% in last few trading sessions. And if we see the overall entire pattern of the market of last 5 months, then it is falling without giving any meaningful recovery in between. So I am of the view that between 22,300, 200, we should look for taking some contra bets. On the outside, again, we could see the levels of 22,000, maybe 500 or 600 sort of levels in the near term. For the Bank Nifty, there also we are seeing some pain, but close to 48,000 levels, the Bank Nifty is having excellent support.
Exploratory longs, right? Shrikant, that's longs to test whether the thesis works or not.
No, because Prashant, the markets are...
No, I agree with you, but I'm just saying that you got to test it, right? And see if it works before you build on. That's all. Sudeep, what about you? What are your views?
Morning, Prashant. Prashant, I like that word, exploratory longs. That was a fantastic term early morning. But yes, Prashant, I feel Nifty, I echo with Shrikant that yes, 22,300, 22,200 will be an important support. And if it gets retested, I guess that would be a major level because that zone has never been retested in the last several, in fact, quarters now, if you see. So, and being in oversold zone, it's just a matter of what trigger would be for a rebound. But from a rebound perspective, also 22,700 now becomes a very important level. So even if there would be short-term rebounds because of the oversold nature of the index, but 22,700 has to be the first level that we should be watching out for from a credible rebound perspective. On the downside, as we said, 22,300, 22,200 zone becomes a very crucial support. From a Bank Nifty perspective, now this index has kind of outperformed Nifty in the last 3-4 sessions. While Nifty had lower tops, Bank Nifty had higher bottoms in the last 3 sessions. So I feel here banking and finance still could kind of provide support to the markets. And from a Bank Nifty standpoint, I feel 48,300, 48,200 becomes a very crucial support. A lot of important Fibonacci numbers placed there. So 48,200, 48,300, we feel could act as a very important support. And on the upside, from a reversal perspective, 48,950 is that zone that I am eyeing for. Above 48,950, Bank Nifty could witness some decent short covering up to 49,400, 49,600 levels in the coming few sessions.
Let's get to stocks then. Sudeep, what would your stock-specific approach be?
Good morning, Rima. Rima, I would like to go with 2 buys now. One is from the NBFC space, Shriram Finance.
We have seen this stock giving decent momentum in the last few sessions, and we feel Shriram Finance has good supports at around 610, 615 levels now. So we recommend a buy here with 615 stop loss and 660, 670 targets on the upside. The second name is from the chemical space, SRF. Here, the stock has given a multi-year breakout. It had already given a breakout before a few weeks, but post that retest of the breakout zone, we have seen SRF trying to hold this 2750, 2760 mark. So this could be positionally bought with 2750 as a stop loss and an upside target of 3000, 3050 in the coming few weeks.
Shrikant, your picks?
Yeah, Rima. See, like these metal stocks or metal sector specifically, they are showing relatively better strength as compared to other sectors. Most of these stocks are recovering whenever there is a recovery in the market, and whenever there is a fall in the market, we are seeing relatively lesser fall. So in that specifically, we like Hindalco, which is currently around some 620, 25 levels. There I'm expecting stock to move towards minimum 640, 650 sort of levels. In the near term, we could even see the levels of 660 because the overall trend of the stock is very strong. So it's a buy at current levels, more on dips with a stop loss close to 615. And we should look for shorting those companies where the valuations are still expensive, which are trading with the multiples of more than 50, 55. There, Kalyan Jewellers looks a very classic candidate to go short. We could see some rebound in the first half of the maybe day, but there we should look for creating short positions on Kalyan Jewellers with a stop loss at 490. I'm expecting stock to fall to the next levels of maybe 420 or 400 again.
All right. Thank you very much, Sudeep and Shrikant, for joining us with that perspective as far as indices go and specific stocks are concerned. We'll get back to you for more in a bit from now. Now, there are 6 new entrants as far as the F&O space is concerned from the March series. Hormuz is going to give us some details. Hormuz, morning.
Morning, Prashant. And some 6 new names, as you just mentioned, they'll begin trading as futures and option stocks in from today's trading session as the start of the March series. Tata Technologies is one of them. Ireda is the other one. The other 4 names include the likes of Amara Raja, IIFL Finance, Titagarh Rail and Patanjali Foods. Now, this also comes after 16 names were excluded from the F&O space after the February series came to an end yesterday. Now, an interesting bit is the fact that most of these names have corrected anywhere between 40 to 50% from their peak. Ireda is almost halved. Amara Raja is almost halved, as is IIFL Finance. Titagarh Rail is down almost 61% from its peak. The only exception to this list is Patanjali Foods, which is only down 9% and is still trading very close to its 52-week high. So keep an eye out on all of these 6 names in today's session.
Thank you very much for that. But it looks like the MSCI rebalance stocks could have a bit of a move today. In pre-opening, I think Hyundai is up close to about 4%. IIFL estimates inflows of nearly $260 million in that. And Hyundai is up close to about 4% pre-open rates. And Adani Green, which is getting excluded from the global standard index and is likely to see outflows of $167 million, that's a stock under pressure. But let me invite on the show now Harshit Kapadia, Vice President Analyst at Elara Capital. Thank you, Harshit, for joining in. First, wanted to check, did you attend the Crompton call yesterday, the analyst meet?
Yes.
They're talking about increasing their the premium fan portfolio from current 25% to 40% over the next couple of years. What were your key takeaways, and is this a material development? Do you expect the EPS upgrades in the stock?
Yeah, morning. Yes, I did attend. So their vision is that their price is between 2,500 and above is something which they call as premium. They are at around 23% and they want to move to 40%. So yesterday's analyst meet highlighted some of the new product launches in this particular premium segment, which are priced above 2,500. So that's a market which is growing in high double digits, and that's what they are targeting. And this is more urban-centric products which they have launched, given the needs of urban in terms of aesthetics, in terms of comfort, efficiency, and power drawdown. So all these features are part of this particular premium product which they have launched. Yes, so this is the way they plan to go towards 40%. It's a 3-4 year target. And if they continue to see more such launches in this premium segment, we are confident they will be moving towards that 40% mark.
Okay. Hi, Harshit. Good morning. Good to see you. And Harshit, any view on these cables, wires players after yesterday's big announcement, Ultratech coming in? Do you track any of them? Any view?
Yes, so we do track cable and wire segment, Polycab and KEI Industries. Yes, it's definitely a very strong move coming from Ultratech. However, the investments which you are seeing is close to around 1,800 crores. And largely given the statement which they have mentioned, they want to be a building product or building solution provider, which would mean they would be more focusing on wires than on cables. Hence, the impact would be largely on companies like RR Cable and Finolex Cables, which have much of a wire in their portfolio compared to Polycab and KEI. Definitely, it will hurt everybody, but not to a large extent the companies like Polycab and KEI. We also have to understand the intent with which they are coming. What would be the strategy in terms of pricing discount, which can set the tone for the industry, because industry is growing at 13-15% per annum. And there is also an opportunity on the export side, which the current existing players are exploring. So that could be a kind of an offset for if companies who are looking more at exports than on domestics to grow. So that is what my limited take on the entry of Ultratech is.
Okay, all right. So would you be positive on these stocks post yesterday's knee-jerk reaction?
I'll be definitely cautious at this point in time, given on what would be the strategy of the Ultratech. So probably if we get a sense from the company itself, then we get an intention of how aggressive they can come to the market and if they can disrupt the market or not. And then I'll probably relook at cable and wire segment. They were trading at around 40 times. Right now, they are most of the players have been now at 30 times and below FY27 earnings estimates. So they are in a comfort zone, but there could be some decline which could come in next few weeks if we unfold the Ultratech strategy. So I'll be a little bit cautious and probably be looking to re-enter it.
We'll hear from the Ultratech management later this evening, and hopefully, that gives a better sense. What about the defense space? Defense stocks were on the offense, but then they have pulled back, to a large deal. Some of the stocks are still positive on those. So what's your top bet in the defense sector?
So my top bet is Bharat Electronics, Hindustan Aeronautics, and Bharat Dynamics. This is how I would play this stock. So I would bet on companies who have strong on order inflows, then on execution, and a very comfort on margin. So Bharat Electronics tick that boxes significantly. HAL, we are sensing that the execution may not have picked up to that extent, given the engine issue still remains. Hope March we should get an engine. That's what most of the commentaries have been saying. But there are some big, large, chunky orders which are expected to some partly come in March and some in FY26. Hence, the order book is only going to see a multifold increase. That's what we are expecting. And BDL has seen their share of sourcing issues, and now they are most of them is completely out of it. Hence, the execution is going to be at much stronger pace for Bharat Dynamics.
Okay, BEL, that's your top pick. Thanks a lot, Harshad, for joining in, giving us your take on some of those cables and wire stocks, as well as on the defense name as well. But let's focus on Coal India. That's one of the few stocks that are opening up in the green. Why is that? Because yesterday they announced on the exchanges that they're going to be going ahead, and for one of their subsidiaries, which is NCL, they're going to be levying a charge of 300 rupees per ton. This will amount to a revenue income of close to around 3,800 crores. How much does NCL contribute as a percentage of their total dispatches? Well, it's close to around 18% approximately. So most on the street believe that though this 300 rupees will be towards development of villages and other activity in the in the mining areas, well, they believe that their capex was already in the price. Now, this will be additional revenue. And since the capex, was already into their valuations, now most of this revenue will flow into the EBITDA, which a couple of brokerages have quantified at around 8 to around 9%, like Nuvama. And that's why they say that this additional 3,800 crores could result in an per share price of close to around 34 rupees. How are they doing that? They're giving it a multiple of close to around 5 times, which they're giving for the company. And as of now, they have a hold rating with a target price of 419. So Coal India, one of the few stocks to open up well in the green. But there's a note coming on Thermax, and Sudarshan joins us to help us out with details on that. It's an initiation coverage, Sudarshan, I believe. Tell us more.
So UBS has today initiated coverage on Thermex with a buy call and target is rupees 4100 per share, implying an upside of nearly 30% from current levels. And it says that it's a diversified and sustainable energy solutions provider, and it has profitable exposure to an expanding industrial energy efficiency market. And because of this, margin increase will drive 25% earnings CAGR over FY 24-27. But the key would be capital allocations. Overall, UBS is positive and with an upside that it's seeing of 30% from current levels.
All right, Sudarshan, thank you very much for that. I think that we've got about 2 minutes to go for market open, and we'll just have the rates start to come up. I don't know if we have Mitesh with us, but okay, 111 points lower on the Nifty as far as the pre-open is concerned. Maybe we can just quickly look at the cable and wire companies first. Those were the biggest casualties. Polycab, KEI, KEC, Universal Cables, so many of those names. RR Kabil was down sharply. So today is more flat, more sort of measured stock taking, which seems to be going on across these names. Maybe look at KEI as well and see what's happening there. KEI Industries. We spoke with the management yesterday. Stock's down about 1% or so. And of course, let's look at Ultratech as well, which, by the way, by close was one of the biggest volume-led losers. That's also tentative, about 0.5% higher. And then, of course, let's look at Bajaj Finance, Bajaj Finserv, Chola, Credit Access, those names. Shriram Finance, which all were participating higher. And I don't know if there's anything there. Credit Access maybe as well, because that was a big 10% pop on huge volumes. Although after all that it did, it's basically back at the not even up at the upper end of this recent last 2 month range, which is around 1100 on the upside.
By the way, Asia's deep in the red. The Japanese index is down 2.8%. Kospi is down over 3%. Hang Seng is down over 2%. So Asian markets is sinking as Trump has proposed an additional 10% on China, which means imports from China will now attract a duty of 20%. And 4th of March it is for imports from 25% import duty on Canada and Mexico. So it's rattled sentiment in Asia.
All right, well, first rate starting to come up on our screens, 0.5% lower on the Nifty, 22,400. The Nifty Bank is about 1% lower, 48,300 on the Nifty Bank. So all of yesterday is 0.5% plus kind of gain being given back. The IT index is down 1.25%. 3:1 in favor of declines. That's the market breadth straight out of the gates. But I think we should give it an hour more, 2 hours more. Actually, an hour is enough, and we'll see if this starts to change or maybe look a little better. But now it's all deep in the red. Look at the Nifty heat map. It's running out. It's at least the start this Friday morning is pretty poor. Got 2 names in the green now left within the first 60 seconds of market open, and everything else is down and out. Mid and small cap indices starting with about 1.5% cuts this Friday. Rima.
Mid-cap index down 1.5%. Small cap index is down also 1.5%. And now the week-to-date losses for the mid-cap index stands at in excess of 3.5%, while the small cap index is lower for 4.5% so far this week. So broader markets underperforming yet again for the 5th day in a row, and losses now for the 5th consecutive session. The mid-cap, the Nifty and the Sensex too are sinking lower, now down 1% on the benchmark indices. The Nifty is down 200 points. The Nifty's breached 22,350. So it's quite a fall that you can see on the benchmark indices. The GIFT Nifty was suggesting a fall of 150 points. The opening has turned out to be deeper, 220 points down now. Top losers include an Innocent Bank. So banks are under pressure. Yesterday they were resilient, but the Nifty Bank is down 500 points. Innocent Bank is weak in trade. Pull up an HDFC Bank and an ICICI Bank. HDFC Bank is down 0.5%. ICICI Bank down 0.5%. But you can see the Nifty Bank itself down close to about 1%. M&M is weak in trade. Tata Steel, JSW Steel, the entire metal complex is weak in trade. IT is under pressure. Wipro, HCL Tech staring at losses of 1.5%. NTPC is another loser. Hardly just 2 stocks out of the Nifty complex in the green. One of them is Coal India on the back of the subsidiary price hikes. That's up 2.5%. And the second one is Shriram Finance, which has been strong this week. Shriram Finance has a gain of 4% this week. It was higher yesterday and it's managed to hold on to those gains. So in the green for now, but other than that, it's all red.
Well, that's right. Shriram Finance actually has been a big outperformer. Valuations had come to those levels where a lot of sell-side analysts had written about it at around that 530 level odd. And that's actually outperformed in the last 1 month or so. Besides that, looking at a couple of more stocks, Coal India, that one is firing away, up close to around 3%. So the street clearly likes this 300 rupee price hike. And also they're a little bit optimistic that this is only for around 18%. Can they do this for a couple of more subsidiaries? Well, that'll be even better news. So Coal India, that's the stock that's doing very, very well. From the broader markets, another stock that's doing well is Transrail Lighting. Why is that? They have won new orders worth around 2,750 crores. At least the first tick was in the green. I'm not sure whether it's still holding. It's still up close to around 2%. So good on them. Good move is what we're seeing out there. IRDA, it's welcome to the F&O trading with the 5% downtick. Stock has already corrected. It's half actually from the top. IRDA, that stock in fact is down close to around 5%. NTPC Green as well as down close to around 4%. Let's pull up Premier Energies for the last many trading sessions, irrespective of what's happening fundamentally. The street has been very, very nervous about this lock-in getting opened out, and that's what's happened today. So for the time being, it's down close to around 4%. The markets continue to remain under pressure, down 220 points or thereabouts. The Nifty Bank is down 450 points.
All right. No, absolutely. 220 points lower on the Nifty is what you have, 22,300. This is, as poor open as, we've got lately. So it's a full 1% cut now coming through in sharp focus, sharp contrast. I can go through many more names here which are down. That's easy to do. It's 10:1. 10:1 declines to advances at this point in time. I'm just spotting any big outlier kind of moves, anything which is managing to kind of sort of, come through aggressively on the other side. There isn't any, actually. There isn't any at all. Maybe KSB, is it KSB Pumps? I'm not sure, but that's a 6% gain. There is something like a Sanofi, which is up about 5%. Transrail is up about 2%. That's it. If you keep a 2% cut off, there are these three names which come up. And maybe RR Kabil as well, which is up about 2% on the other side. So those are easier to spot in what is otherwise an absolute sea of red coming through. So that's the overall picture.
KSP is actually the results came, I think so. It's a calendar year ended. So out there you had the revenues that were up by around 21%. Gross margins came in at around 43%. And the EBITDA number as well was up by 22%. So I guess that's the reason why the stock is up.
All right, standing out, shining, otherwise sort of tough kind of open. Rana Gupta, is Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good morning. Great to have you with us here on the program. Appreciate it. Prashant this side. It's getting worse and worse. And, at some point, it will turn. But Delhi kitni dur hai, Rana? That is essentially what people want to know. Are we in for a lot more price damage, time correction? What's your view?
Good morning. Glad to be on your show. Although, the markets are all red and it is easy to be, quite pessimistic about the markets. But I think let's put this fall into some context. The correction really started from October, and since then, markets down about 15%, broader market more than 20%. This includes earning cut over 5-7% and peak correction about 10%. What we are seeing is now that even on the cut EPS, markets have reverted to average valuation, and India's premium to the emerging markets is almost disappeared. It's just a little bit of it left as compared to what it used to trade at. So valuations average, valuation excesses have gone. So now the growth needs to pick up. With respect to growth, we think that as far as the domestic policymakers are concerned, through tax cut, RBI's measures, through liquidity and otherwise, they're trying to revive growth. But all this is for now not effective due to the bad sentiment and the FPI outflows. Once the FPI outflow stabilizes, I think you will see some of these measures kind of filtering through the system and some sort of stabilization. We think that because the Nifty is at average valuation, price damage has happened, while the confluence of positive that is building up, like policy intervention or a bit of a better recovery in rural, is not getting noticed today. But at the same time, coming out of this will take time. Patience will be required because of global uncertainty and the flows into stabilize.
So till then, as we navigate through these tough times, what are you doing with your portfolio? As money comes in, where are you deploying it? Or are you sitting on cash right now? And when might, the sentiment in the market turn?
Sure, I think that we have in the view that although the market may stabilize, it will take some time. Market may stabilize before consolidates here, before any advances. But one thing we have been clear for some time that even when the market bearing stocks and it recovers, the sectors that could lead the market up will be different than what the last bull market has happened. In the last bull market, we saw remarkable results and stock performance from industrials, PSU, and utilities companies. I think that is going to change. And we think that next bull market, or whenever the market upturn resumes, it will be led by mostly consumer and financial stocks. Even within financials, we like the non-banking financials more than most of the banks.
Okay, all right. So you're looking at the NBFCs?
That's right.
I guess cost of borrowing as well will come down with these rate cuts, and the valuation wise as well, they had come to pretty attractive levels. The other space, Rana, that you liked is the EMS space. I think we briefly spoke about it in the past.
Correct.
You were looking at some rural themes as well. So if you could give us the top two themes that you're looking at. The EMS space, by the way, has seen a big correction from the peak. Though in the longer term, runway is still there, and they have a lot of growth that's ahead of them. The problem was valuations, which have now corrected. Will you be positive at this particular juncture?
Sure. To be clear, in the EMS, we are bullish on the EMS ancillaries. May not be the stocks that are leading in market cap. Somewhat low in market cap. The ancillary EMS is the space that we like. Nonetheless, they have also seen quite a bit of correction. And you are right. I think the long-term runway remains very good. The valuation has corrected. To be fair, I think there has been some project delays as well. But I think going forward, we expect to see a lot of policy response to let the EMS growth resume again. So that is something that we continue to like. In terms of rural, I think after a long time, we are seeing some signs of life in the rural economy. And I think that can be best played through something like a tractor companies, and also the non-bank financial companies, which is exposed to rural segments, particularly in the secured segment. That is also one segment that we like.
Can you just explain that to us, Rana, with regard to the EMS ancillaries? What all comes under that category?
If you think of, let's say, all electronic items, whether it's a mobile phone or your TV or your AC, these are all made of some components, right? So, and you require machining, tooling, CNC machines to make those. So that is the value chain that we like. Because if India is going to produce all this internally, a lot of machinery requirement will be there. So that is so companies which are setting up scale to produce this, or the machine that is required to produce this, is one segment that we like.
Got that. So, Rana, the basic broader question is some of the high-flying sectors like EMS you spoke about, defense, manufacturing, industrials. When there was a lot of money coming in, valuations, I guess, were jacked up to extremely high levels. But they are still high. The question, though, is that the new... have we entered a new normal where 50 times, 55 times for companies, without naming, I can, is the new normal? Because valuations actually have been high for almost 10 years now, 10 plus years. They had gone to 70, 80 times. Now they're back at 50, 55 times. What is your sense, Rana? Or you think that will depend on where interest rates head?
I think on valuation, if you go into sector and stock-specific levels, it's very clear that Indian markets rewards the companies that can show earning growth. In general, also, if you take a step back and look at the flows into the market, particularly from the FPIs, it has happened either when the valuation was low, let's say in 2020 when COVID correction happened, or something like 2023 when the earning momentum was very high. So I think broader point is, even if you go to the sector level, the companies which can deliver earnings, they will be rewarded. And the valuation tends to overextend, and when the earning growth cracks, valuation reverses. I think So getting the earning growth right will be the main thing. I think the companies which can maintain good earning growth much ahead of the industry, they will continue to trade at premium valuation. And the companies which cannot maintain the earning growth will suffer valuation correction. So I think for us, getting the earning growth right within the segments that we like are very important.
So if a company is, say, growing at 30-35%, what's the right PE multiple, Rana, in your opinion? That's
So
the
if you're
top end of the
looking
growth. That's the top end of the growth companies, right? So what should be?
Yeah. Sure. No, of course. So, it will be not, in my view, it will not be right to look at like just a 1 year growth, because when you talk about valuation is about the durability and the sustainability of the growth and how much of cash flows are coming. So 30% growth is fine, but the 30% growth can continue for how long? For example, let's say if you are putting, for example, instance of 50 PE on FY27 based on 30% earning growth, and in FY28, the earning growth dropped to 15 or 20%. I think in that case, one is kind of pretty much sure to make losses. The idea is that whether 30% growth continues for some period of time or not, so that when you exit, even then the growth rate is also quite high. So that is very important, and that is why one has to get into areas which are, relatively speaking, underpenetrated, or the growth runway is very long.
So Rana, what about cables and wires? Now, most of the companies there are likely to grow according to estimates by 15 to 20% over the next 2 to 3 years. So there is growth. But the problem is, after 3 years, once Ultratech Cement comes into the market with its product, so what should one do with stocks in the cables and wires segment? Were you buyers in the first place, and now what are you doing?
See, cables and wires is one segment that we liked because of the companies here are, they're all financial ratios, whether it's earning, whether it's margins, whether it is, growth, ROE, all look good. This industry looked good because, again, talking to what I was just saying, durability of growth, right? So power transmission, when it happens, and because of renewable power investment, a lot of power transmission projects will happen. So within wire and cables, we like the cable side quite a bit, although cable side is a B2B business, but I think the growth runway is long. Now, if some company can top up the cable business with some high margin wire businesses, I think that was quite a good growth combination. That said, we are watching Ultratech's entry into this segment, but their entry is at least 2 to 3 years away, and our own sense is that in 2 to 3 years this industry will grow by 14-15% to accommodate a player like Ultratech, given the kind of capital outlay they have said. However, what we do not know today is that Ultratech, when they come in, will they stop at this kind of 2,000 crore investment, 10,000 crore top line, or whether they want to go more for it? So I think this is one emerging sign that you have to monitor across the mid-cap space. Wherever the mid-cap companies have been really profitable, we are seeing the large conglomerates are entering. You can think about even the cola businesses, right? Where it's now almost large cap company, but where the companies have done very well, the mid-cap companies became large cap companies. There, the giants are now entering. So when we look at mid-cap stocks, we have to be quite conscious about what kind of competitive threats that they will see going forward. Because at the end of the day, going forward, that can increase competition, and we have to also be very careful about the growth aspiration of the the top rank, the new entrants.
Thank you, Rana, for your conversation. It was a pleasure chatting with you, and look forward to the next one. Enjoy the rest of the day. We'll focus now on the consumption space now. Now, Saugata Gupta, Managing Director and CEO at Marico, says the worst is over, but urban consumption has been stressed. My colleague Manglam caught up with Saugata Gupta and began the conversation by asking about the growth trajectory for the company.
If you look at the total environment, over the last couple of quarters, rural is improving. Urban consumption has been stressed. Having said that, we believe that the worst is over. It will gradually improve. Obviously, the improvement will not be, like a hockey stick kind of a U-turn, but it will improve definitely. Now, I think as far as Marico is concerned, 2-3 things I would say was slightly different. One is, of course, our significant focus on our diversification and transformation of our portfolio to make it future ready. If you look at around 2020, the composition of food plus digital plus premium personal care was around 6%. Today it's 21%. So that is giving us that growth. The second thing is that we have been also not been cutting A&P to manage margins, but doing a far more institutionalized cost management program. Thirdly, some of the issues in the system we called out pretty early. For example, things like GT being under stress, the fact that there is a potential channel conflict, investing ahead of the curve in new channels, and of course the fact that if FMCG companies don't actively participate in the D2C space, they are likely to get squeezed out at the top of the pyramid. So I think some of the things we have taken proactive steps, and therefore that has resulted in that we are still being resilient in this situation.
So 6% volume growth is what you reported this time around. How far are you from the 10% mark? Because, you know, it's a function of what you're doing and it's a function of what the environment is doing as well. Rural you called out as improving. Urban may not be hockey stick. What does the very near future and medium term look like for you?
So I think it's very difficult to say when will 10% happen. I think the question is that we have, if you look at sequential quarter, we moved from 2, 3, 4, 5, 6, and that's been the kind of a movement. I think a mid-single digit is something which is eminently possible. Our endeavor will be to gradually move that to, you know, high single digit. I think 10 is something which, again, is something which will depend on the environment and other factors. But as of now, I think our aspiration is how do we inch this up a little bit. I think what we are more confident about is, given there is a bit of a, you know, pricing equation that is there, to deliver double-digit revenue growth quarter after quarter over the next couple of quarters, and that's something which we are pretty confident about. Our endeavor obviously will be to continuously try and deliver top quartile volume growth.
What about the margins? Because your anticipation was 20.5%. You fell short of that by about 100-150 basis points. That was largely on account of the sharper than expected inflation that we saw. Where do we see that going?
So I think the inflation cycle will continue for the next 2 quarters. Okay, so as far as the copra is concerned, we are broadly at the fag end of this inflation cycle. It's usually 18-month cycle. We expect things to improve sometime towards the end of quarter 1. So obviously there will be a lag and things will start improving from quarter 2. As you know, in edible oil, there's been a 20% duty, which is something which obviously has resulted in some kind of an inflation. I think as far as margins are concerned, there will be a situation where the first 2 quarters will continue to have some impact, but it will start easing off towards the second half of the year.
So how much lower can they go before they go back to that 20% mark?
I think we are in that zone right now. I don't think there will be a significant squeeze beyond this. But having said that, I think our endeavor will be to move it to 20 as we, you know.
But then you'll have the leverage coming in from all your new brands, etc., where they are improving their operational parameters as well, right? So would there be significant growth in margins beyond that 20% mark, or you believe in, passing on the benefit to the consumers and hold your margins around that 20% mark?
So I think value to the consumers is important because we have taken some significant price increases. Similarly, as far as the digital and the new business is concerned, obviously our endeavor is to continuously improve margins. So to give you an example, if I look at the oats plus masala oats business, which is core of the current food business, that delivers an EBITDA close to the company EBITDA. Okay, I think I would say there will be 2 milestones. One, can we get the digital business, which is a very high growth business, to get into a double-digit EBITDA? Beardo is already delivering that. Plix is positive. There is a bit of a cash burn in terms of the other 2, which is True Elements and Just Herbs, but it's minor. It's not major. And so I think as long as, and we are much more comfortable with say a 30% growth with continuous improvement in profits versus delivering a 50%, 60% growth with a high cash burn model. Okay, food is also improving, so I think the margins will creep up, and I think even in our international business there are opportunities for scale-driven margins. But as you see, we are in emerging markets. When we operate right through, in our international business and India and emerging markets, India, and the focus is to invest to grow. It is about getting new consumers. It is about getting existing consumers to consume more, grab market share, and continuously diversify.
One thing that stands out is that in all the traditional FMCG companies, you've been among the first few to get onto this D2C acquisition bandwagon. So 5-6 years into this acquisition bandwagon, if I had to ask you a couple of questions, what is it that you learned from them and what is it that you taught to them? And as a result of which the synergies were created, how would you reflect upon that?
I think three things. One is digital marketing. I think something which we have really learned and tried to improve our capability in that. The second thing is high velocity innovation, risk taking, and ability to gather insights from the environment and quickly launch. So it's about think big, start small.
Could you give me specific examples?
I think if I look at the innovation cycle compared to a traditional FMCG company versus say some of these D2C companies, it's severely crunched. They are happy to take small bets and risks because the risk appetite, I would say the risk appetite is high, but I think the value at risk is always low. I think what they have learned from us, I think, is cost management, governance. I think also a little bit of framework for choice making, because unfortunately in some of these companies, I'm not talking of our companies, but we have seen some of the startups, it's about spray and pray.
Yeah.
I think that ability to do sharper choice making without analysis paralysis, and something which they have learned from us.
And what about the threats? What do you think would be the potential
I think the 2-3 threats obviously is that core slowing down. I think whenever there is significant pricing interventions, and if I look at volatility of raw material, commodity, and therefore we are actively ensuring that we de-risk ourselves from commodity dependence.
How much has it de-risked? Ever since you joined, I remember over 60% of your revenues would come from...
I think there's been a significant de-risking, and we still want to continue the journey. And I keep on saying that my aspiration or ambition is that we do an analyst call 3-4 years from now where copra is not discussed.
Okay, that's an interesting one. So how much do you think have you decommodified your business? Not just copra, but even edible oils?
Yeah, so as far as edible oil is concerned, I think what we have said is that the growth of the Saffola master brand has to be through foods.
Yes.
And again, in foods, we are cherry picking categories which have higher margins. I mean, there's always a temptation to get into things like rice, pulses, and spices and all, which will give me quick growth. Yes. But we have resisted the temptation to do that, because I think one of the things we said that the food business should be far more margin accretive. And maybe 3 years from now, food will be bigger than edible oil in the Saffola.
50-50 was your target, I remember. Where does that number stand right now?
It's still around 30-70, 35-65, it hovers around that. But it should be 50-50 very soon. And maybe 3 years from now, we should be a higher food business,
Interesting conversation there. He hopes that in the future, at some point, the conversation does not center around, parachute and the prices over there. We'll slip into a break on the other side. We've got another corporate conversation lined up. Ishank Desai of Mastech will join in about the multi-million-dollar contract that they announced yesterday from UK Public Service Department. Welcome back. Let's talk about Mastech now. The company has secured a multi-million-dollar contract from UK Public Service Department with an estimated value of $85 million over a 2-year period. To talk more about it, we have Ishank Desai, Vice Chairman and Managing Director at Mastech, now joining in. Mr. Desai, morning, and thank you for joining in. First, tell us a little bit about this recent order win, and there have been a spate of order wins, particularly from UK. What's the current value of your order book?
See, as we expressed it in our press conference, it is around 85 million pounds to be executed over 2 years. It's kind of, in dollars, around 100 million kind of order. And we need to execute it over 2 years. It is digital transformation and managed services. So in a way, it is fairly balanced kind of contract. It will give us one-time revenue as well as continuity in terms of managed services.
what is the value of the one-time component, and when will you accrue it? Will it be in Q4 or will it be next quarter?
No, I think one time itself continues for 2 years because it's a large contract. So it's not that it is to be done in Q4 or even next year. It will continue execution, slowly tapering off and going to managed services, obviously.
So what is the component of the one-time revenue which is spread over 2 years?
Sorry, couldn't get your question, Rima.
So what is the amount that is spread over 2 years, and what is the amount which is managed services which will keep accruing slowly after 2 years?
No, this particular 85 million pound is including managed services in that 2-year period too. There will be a continuity beyond 2 years as we execute this project well. But I can't give you a breakup between managed services and one-time project execution. It will evolve as we go along. It's a project of a national importance, and it's something that we have to execute well, and we are very happy that we got it. We have been doing such projects, as you know, in UK of national importance, and that shows the confidence of our customers in executing large projects, long-term projects, and it's a hard work of many years that we are in this business, last 20 years, in fact. So this is about Mastek's ability to deliver mission-critical large systems, which are very important in coming years if you have to execute AI and other projects. So that is a benefit that we get, and we feel good about it. It is also in AWS area, so we have been moving very big way in terms of partnerships, and this gives us a great capability in terms of executing large projects in AWS, and we'll be one of the major players there.
Got it. So how was Q4 shaped up for you? Because Q3 was a tough one. There were extended furloughs. Q4, what kind of a growth quarter is it going to be for you?
See, Q3, yes, in revenue terms, you are right. However, you must look at 22% increase in year-on-year profits, 16.5% increase in EBITDA, almost 20% increase in healthcare part. So there have been a lot of positives there which are not being noticed. What really happens, Rima, is we are in the business of such projects also. Some of them don't turn up in that quarter, some of the execution gets support. So I would like to really look at it on year because that gives a better feel of what we do. As far as quarter four goes, sorry.
Yeah. Please go ahead, sir.
Yeah, so the quarter four goes, we have said that we would like to move in the direction of growth, and we would not like to comment specifically. As you know, we are not giving any guidance per se, but this kind of projects execution does give us a better visibility, hopefully.
Okay, all right. Hi, Mr. Desai. Good morning and good to see you. And since you like to look at it on an annual basis for FY26, can you grow in double digits?
See, Nigel, I think we should look at it. You have been in industry for many years on CNBC. We look at it the longer term aspects. If you look at last 4 years data from 1920, just 2021, just before COVID started, and now, we grew 18%. We almost doubled in last 4 years, which is 18% growth, as you know. Whereas industry grew at around 11-12% in rupee terms. We would like to continue that kind of movement where we grow faster than the industry next year. This year also, hopefully, we may be able to do that. So I would not give guidance other than saying that we would like to exceed industry kind of overall industry growth.
UK is about 57% of your revenues, and that's doing well. The one order we spoke about right now, £85 million. But even prior to that, there was a $40 million win from an existing client and a $10 million new one from the UK government. Will UK outperform the company's growth averages? Can UK grow in double digits? Do you have that kind of confidence?
See, what happens, Rima, really is these are large projects, so they get noticed, obviously. In US and other geographies, projects are not of that size. We continue to get large orders, even those countries, like in US, we book 5 million order. We may not get it published all over the place. but there are multiple such orders. So the point I'm making is we are growing also in other geographies, particularly in US, because of our positioning in particularly Oracle. As you know, we were one of the top 5 rated globally by one of the analysts last year. 5 globally cloud implementation of Oracle. 3 of them were from outside. 3 of them were of Indian origin. 2 were from outside, without naming all of them. But Mastech was one of them. So we have such positioning in US, which gives us a good headway in multiple sectors like healthcare, education, so on and so forth. In Salesforce and customer experience, we have acquired this company, as you know, which gives us declared into healthcare, particularly in government. So we are confident that we may not see a difference in terms of growth. Yes, there can be some plus minuses across sectors, but we see a growth coming all around.
By the way, the Nifty IT index is the worst performing sector today, 3.5% lower for the Nifty IT index. And this year, it's down close to about 13.5%. So after growing at more than 20%, 25% over the last 2 years, 2023 and 2024, IT has started 2025 on the back foot, underperforming, maybe some, NVIDIA hangover. But Mr. Desai, is there any fear of a tax on services which could negatively impact Indian IT companies? And given the general tariff overhang, what are corporate conversations like? What are clients? Is there that fear of uncertainty? Is it delaying decision-making, deal signings, deal conversions?
We have not seen a lot of delays, Rima, in terms of deal signing. But coming back to your important question on tariffs on services, now that's really a slippery area. You see, there is no clarity on how do you charge tariffs on services, because services offers in all kinds of things, as you know. It includes banking services, consulting services, like what we do. So as of now, the focus is only on trade, which is very well definable movement of products. The services move along, telecom lines, as we all do in offshore, and then there is this movement of banking services and so on and so forth. So I'm not really worried about services getting some kind of tariff, because it is extremely difficult to first define and then implement both ways. So I kind of feel that it may not happen, but let's see what as it comes across.
Okay.
But it's going to be
no, absolutely. We just hope it doesn't happen. Not just for IT services, but even as someone was pointing out, IT services is one thing for India and it's very important. But even GCCs, right? I mean, they are essentially the growth driver now in terms of services exports. One just hopes that all of that stays out of the ambit of whatever is being discussed right now, and will be discussed in the future.
See, what happens really is that we are not charging any tariff on services coming from outside India. So if it is going to be reciprocal tariff, then it better be same, right? Even if I go by that logic.
Who knows? I mean, the basic logic seems to be Meri Marzi, but we'll see. Thank you very much for joining us. It's a pleasure having you with us, and I hope look forward to our next one.
It's always
Thank you.
pleasure to be on
Thank you.
CNBC.
Thanks very much. Well, let's focus on the real estate picture now. Tier 1 residential sales have seen a pickup, did see a pickup in 24, but the question is, are things starting to slow down a little bit? I mean, this is a topic we picked up about 2 months back. And this is essentially when the markets had started to weaken a little bit. I remember speaking with companies like Signature Global and others and asking them whether the dull price action, at that point dull, now of course pretty severe on the downside, is going to start to show up in real estate sales as well. So let's revisit that topic now. Rajat Kathuria is CEO at Signature Global. Niranjan Hiranandani is chairman of the Hiranandani Group as well. Gentlemen, great to have both of you. Thank you very much for joining us. Prashant this side. Mr. Hiranandani, that question to you, sir, first. Are we starting to see the negative wealth impact with regards to equity markets show up in real estate sales, sir?
Prashant, the reverse is true. we are seeing a 10 to 12% growth in volumes. That has already happened across the board. And I think that's a positive story in terms of the real estate growth, as you see. What is worrisome, Prashant, is not about the growth of real estate, but the growth of affordable housing. That's a negative. Look at the ideas and numbers, because you talk about numbers quite a lot on your screen. In 2020, the affordable housing segment was 40% of total demand. Today, that is less than 20%. So you can see what is the growth. So in spite of a 10 to 15% annualized growth in the last 4 or 5 years, you have seen a downward trend in terms of affordable housing growth. And I think that's the biggest challenge as far as India is concerned. We also are seeing the luxury segment and the mid segment grow faster. So you're going to see a growth of 10 to 15% growth annualized over there. But of course, there are sectoral setbacks. So you do see certain areas in the country where the growth story is not as strong, especially where the infrastructure is not so good, or the traffic issues are not being sorted, or there are environmental issues which are being challenged. So yes, I mean, I'm talking about an average growth through the country. So overall, Prashant, I can tell you this year equally will see a 10% growth in terms of volumes of this thing. My challenge has been the government's trying to do taxation, which is far beyond the thing. Let's take Mumbai, for example, as an example. 50% of the cost of my flat in the redevelopment property that I'm doing goes to government directly and indirectly. So there is land under construction, development charge, additional FSI cost, all the rest of it put together comes to GST, stamp duty, etc., comes to about 50% of the total value of the flat. Now, with the ready-reckoner rate again slated to go up in Mumbai and Maharashtra, you will see further deterioration in terms of affordable housing taking place. So government actually has actually decided to collect more funds and more taxes and more development charges from real estate. So while on one side housing is growing, the volume is growing, numbers are growing, prices are going up, but on the other hand, affordable housing is becoming a bigger challenge in the country. And I think that is an issue which government is not able to address in spite of the Prime Minister's Awaaz Yojana.
No, absolutely. The question is, if the stock markets remain like this, on a lighter note, you know, those looking to buy premium will have to go affordable. I don't know. But
Prashant, it doesn't. Prashant, as it stands just now, it's not happening. I can tell you that much on the ground.
So you're saying there is no impact whatsoever, even marginal impact of the markets being depressed? Because especially in a city like Mumbai, where
Prashant, is the reverse. It's actually reverse. It's going up. People are moving from the stock market into the real estate market.
That is what we had Mr. Abhinandan Lodha with us here, and he made 2 months back. He made the point. He said there is one wave which is he thought, and maybe it's happened back then. He said, well, which will move out of equities and move into real estate. So he was kind of making that sort of point, and he agrees with you. I guess. Rajat, come in here in your market, NCR, Gurgaon. Again, I mean, my question is with regards to how stock markets are doing, and whether there is. I think you did tell us last time that it is maybe at the margin the sales velocity is slowing down. Go on.
Yeah, hi Prashant. Good morning. So Prashant, this is real estate tends to be a very localized micro market driven business. What we are witnessing in Gurgaon is that while urbanization trends are strong across the country, I think Gurgaon specifically, as far as the NCR market is concerned, has seen very strong migration trends from other parts of the region into people moving into Gurgaon for a variety of reasons. And, you know, we've been quite, I would say, up to tapping this particular opportunity. So the trend by and large is that price rise, which saw very, sharp spike about, 1.5 years ago. Price rise has moderated while it still continues to go up because there is still
lack of good quality homes which are available to customers. Hence, price continues to go up, but at a moderated pace. But transaction volumes are steady. So I agree with Mr. Hiranandani that volumes are staying steady, and we are not seeing any sort of decline in transaction volumes as of now.
Okay, not seeing any decline in transaction volumes as of now. That's good to hear then. Mr. Hiranandani, in the city of Mumbai, right, which is where you operate, how is there's so much supply which is coming up? I remember we had one of the consultants on the program, and he gave us a figure, and this is in the premium end, between 15 crores to about 40 crores, and if you have that number, do weigh in. We have enough supply which is coming up for the next many years in the city of Mumbai. So supply, essentially, according to him, will overwhelm demand in that product category. Just come in there, Mr. Hiranandani.
Prashant, I cannot vouch for the future. I can only tell you what the present demand is. The present demand is enormous. So there is no shortage of demand as it stands today. Number two, you have to see very clearly what is happening in terms of total numbers. So while the total volume of real estate has gone up, while the stamp duty collections have gone up, while realization of GST has gone up, the total number of apartments being sold has come down. That is the challenge. And that
is on the affordable side, Mr. Hiranandani, right?
Yeah, so that's why overall. But
affordable, for the last few years, sir, there has been no momentum in affordable at all. We've spoken with lenders who've told us that, I think Rajat, who runs Signature, who's with you now, he's moved from the affordable side to premium because there is no, there wasn't very much demand. But that, I think, also was a function of the, premiumization, booming markets, and that's why I started with that question, sir. Go on, Mr. Hiranandani.
Prashant, I beg to disagree with you. Even in the cases of Panvel, where we operate in a very large way, the demand for 2-bedroom and 3-bedroom is much, much, much higher than the 1-bedroom that we are seeing. And we are also seeing that this upgradation which people want, people are looking at larger apartments and other luxury items which are to be added, even in the other cases. So similar to what you have, that the premium cars are being sold better than the other, which is the lowest value models, which is contrary to what the market expected it to happen. Similar is taking place in the real estate sector. So what you're seeing in the automobile sector, we are seeing it in the real estate sector, and government is actually responsible for it because they're constantly increasing the taxes in terms of land, the value of land, the ready reckoner rates, which actually forces you to sell at higher prices and other things, even in the case of land. So affordable housing is getting pushed out of the market. So it's not only developers who are doing it or the market is doing it, you're also creating a large amount of affordable housing to become unaffordable automatically by way of taxation. So both the reasons are there. One, the market side in terms of the visualization of what the customer is doing, his ability to get loans from the banks at the lower rate, and this rate is coming down. So one from 8.7, it's already down to 8.4, 8.5. I think with the reduction in interest rates which will take place, the EMI will keep on following. So you are going to see much more buyers in terms of housing. But maybe, I don't know about the segments, and I do hope affordable housing takes a pickup also. I'm praying for it.
Okay, all right. Hi, good morning, gentlemen, and welcome to the show. This is Nigel on this side. Mr. Hiranandani, I wanted to ask you about, there's a new player that's going to be coming into the market with cables as well as wires. That's Ultratech. As of now, you must be sourcing some cement from them. Does it make a difference, if you're sourcing cement from a particular brand? Will you also be looking to take your cables and wires, or do you think the market is good enough, and you'll continue with the current relationships that you have? Just want to understand from a stock market perspective, because a lot of these cables and wires players are very nervous yesterday from a pricing perspective, as we have a new player that's coming in the next 2 years or so. Your take.
every market is challenged by new players. So there is nothing new about it. We have seen new people in terms of supply of materials every time and everywhere. So yes, there will be a challenge to the market in terms of it. Just like new players in the real estate market will make a difference, new players in every market is going to certainly make a difference. And I would look at the challenges as a real challenge. So you will see new suppliers of materials. We already do. We resource different materials from different suppliers, and new suppliers do come up with innovative products at very, very competitive rates. Incidentally, the overall prices have actually gone up, whether it's cement, steel, or others in the last 5 years. So anybody new coming in will actually get an entry level. Definitely, whether they are able to sustain the competitive prices or not, I don't know. But you can see the profitability in terms of the companies which are taking place and the bottom line of the company.
In fact, it could be good news for you because you all will have more amount of suppliers, and in fact, you could get competitive rates as well. So better news for real estate players. You have higher amount of cables and wires players.
No. Wait. Land is the biggest problem. Approvals are a big problem. The cost of development charges is a big problem. The ease of doing business in real estate is getting worse, not better.
All right. I think, Mr. Hiranandani, impassioned plea. And I hope the government is listening, authorities are listening, sir. So you make some very, very strong and forceful points. And I really hope authorities listen to you. Rajat and Mr. Hiranandani, thank you very much.
You're wishing, I'm praying.
Please do. And we'll connect on this topic soon again. Thanks very much for joining us with that sort of status check in terms of real estate sales, both here in Mumbai and NCR, two of the highest value, highest volume, and probably the largest sort of real estate markets in the country as well. We'll take a quick commercial break. I mean, with news, of course, that the markets have gotten a little worse off. 300 points down now, 22,240. We'll get you a quick price action check in just a bit. Stay with us.
Welcome back. 22,250 on the Nifty, down 300 points on the Nifty. Sensex lower by 1,000 points. We started trade down 200 on the Nifty, and now we're down 300 points. But look at the advance decline ratio. One stock advancing for 12 stocks declining. We've got about 23 stocks currently in the red for less than 200 in the green right now. So that's, the picture in the broader markets.
I just want to point out two names, right? Just tells you the kind of market we're in. If you can have IndusInd Bank up, it is down sharply because I think there's a weight change, right? As you
there is a weight
down.
up.
Weight up. But
despite that, it's down 5%.
You know, but the point also is it had bounced to about 1,100, 1,150 rupees recently. It's back down under 1,000 rupees now. Look at credit access. We should put that up. It was up 10%. It closed up 10%. It's down 7%. Basically, you can. It's the market where there is just simply more supply as compared to demand out there. So even as there's a positive news flow on the back of it, maybe the stock should be bid up on that particular day. It's not lasting. There is supply which is eventually overwhelming demand. So unless you have time on your side over and you're willing to hold on to some of these positions, I mean, I think that is the basic number one requirement in a market like this. Don't try to trade a market where the trend is turned, at least for now, on the way down, because there will be supply. And that, I think, is very, very clear from the price action on some of these names that we're seeing. Nagaraj Sethi is with us, Senior Technical Analyst at HDFC Securities. Nagaraj, good to have you with us here. Thank you for your time. 22,250 now, Nagaraj. Where do supports lie, and what's the trade, if there is one, at least on indices?
been in a sharp downtrend, no doubt about that. On the charts, the opening downside gaps are forming without fulfilling in the near term. And this is indicating that more pain is likely for the Nifty in the near term. So recently, the important support of 22,400 has been broken on the downside. Now Nifty is trading around 22,250 levels. I think the next support would be around 21,800 to 21,900 level, which is the logical support. The important swing lows of last year, February, March, and April during that period. And the Prashant, the nature of the market is like the way market has been coming down. Finding the support is going to be very tricky because the strength of a downtrend indicates that important supports gets broken easily on the downside and smaller resistance are kept aside. That's what exactly happening, and I'm expecting a further weakness in Nifty towards 21,900 to 800 levels in the near term.
Okay, headed down towards 21,800. What about any stocks? Nagraj?
Yeah, yes, Rima, I have two stocks from a short side. In fact, one is from a IT side. Tech Mahindra has been in a downtrend over the last 4-5 sessions, and recently below the 200 DMA, the downside momentum has been accelerated. Currently trading around 1515 odd levels. One can look to sell at this point of time, and the downside target would be around the 1440, 1445, and one can place a stop loss at 1550. And the second one is from a Granules. Granules has been in a range-bound action recently. Today it has witnessed a decisive downside breakout with a gap down opening. The overall trend setup chart pattern is looking negative. I'm expecting more decline in Granules. Currently trading around 473. One can look to sell at this point of time. And the immediate downside target would be around 450. And one can place a stop loss of around 490.
Okay, all right. Nagraj, we'll leave it there for now, and we'll come back and speak again soon. We'll take a quick commercial break here as well with news that it's a sobering Friday morning, 300 points lower on the index. Our special segment, it's the economy coming up next. Third quarter GDP data is due this evening. What should we expect from the numbers? And how's India's macro picture shaping up? Lata will be in conversation with Suvadeep Rakshit of Kotak Institutional Equities and Upasana Chachra of Morgan Stanley. Stay tuned.